Everyone knows about the Great Depression. Everyone remembers the 2008 crash. But the story of financial crises is far older and far more instructive than most realize. There were crashes long before Wall Street, before the Federal Reserve, even before modern corporations. Crises that didn't just disrupt markets, they reshaped the rules of money, wealth, and power itself. Today, we uncover the hidden history of these financial upheavals and why they still matter for your money today. From the earliest markets to the global economy we navigate now, financial crises have been constant, unforgiving teachers. The first recorded bubbles weren't about stocks or cryptocurrencies. They were about flowers. In the Netherlands of the 1630s, tulips weren't just plants. They became objects of speculative frenzy. Prices soared beyond imagination. One bulb could cost more than a house, and then suddenly it all collapsed. Investors lost everything overnight, leaving a generation with empty hands and a hard lesson. Markets detached from reality are fragile, and greed is timeless. A century later, in 1720, Britain faced the South Sea bubble. The South Sea Company promised riches from trade with South America. Shares skyrocketed, fueled by hope, hype, and human desire for fast wealth. When reality failed to meet expectations, fortunes evaporated, trust crumbled, and the government had to intervene to stabilize the markets. This wasn't just a financial event, it was a societal shock, teaching early lessons about speculation, regulation, and the cost of collective euphoria. Across the Channel, France experienced the Mississippi Bubble. Led by John Law, the Mississippi Company promised unimaginable wealth from the New World. Investors poured in their savings, convinced of endless gains. But soon, the dream unraveled. Economies faltered, confidence collapsed, and a nation learned that illusions of prosperity can destroy even the most powerful institutions. The 19th century brought new complexity. In 1825, Britain saw the first modern financial crash in peacetime. Joint stock companies proliferated with little oversight. Risky loans expanded unchecked, and when trust faltered, 70 banks failed. The shockwaves traveled across continents, affecting Europe and the Americas. Investors realized that credit without discipline is a ticking time bomb. Soon after, the United States confronted its own challenges. In 1826, firms on the New York Stock Exchange collapsed due to reckless practices and fraud. It was a defining moment for corporate governance, spurring early laws that protected investors and laid the foundation for financial transparency. Markets without rules, history showed, invite disaster. Throughout the 18th and 19th centuries, banking crises continued to unfold. In Amsterdam, credit tightened after the 7 Years' War. Overextended lenders found their collateral, often grain or commodities, devalued. Banks teetered, threatening systemic collapse. Only intervention by the central bank prevented catastrophe. By the late 19th century, events like the Australian banking crisis of 1893 showed the peril of speculative lending and unregulated property markets, leaving lasting scars on societies and economies alike. By the early 20th century, financial shocks were no longer isolated. The Panic of 1907 in the United States revealed vulnerabilities in a banking system without a central lender of last resort. Private financiers, led by J.P. Morgan, responded to avert collapse. Morgan had to intervene to restore order. This crisis directly influenced the creation of the Federal Reserve, a defining institution in modern monetary policy. Later, the stock market crash of 1929 plunged the world into the Great Depression. Excessive speculation, high leverage, and fragile credit systems combined to create economic collapse. Governments responded with reforms, including deposit insurance and the Glass-Steagall Act, shaping U.S. financial policy for decades. Each of these crises, though separated by time and geography, reveals recurring patterns in human behavior: greed, herd mentality, and the mismanagement of risk. They demonstrate why regulation, transparency, and oversight are not optional. They are essential. The lessons learned informed investor protections, corporate governance standards, and the rise of central banking, all mechanisms that defend modern financial systems. As the global economy became more interconnected, the stakes grew higher. Crises such as the dot-com bubble and the global financial crisis of 2008 showed how innovation, complexity, and speculation can spread risk across borders. Regulatory frameworks evolved, seeking to mitigate systemic failures and protect everyday citizens. But the tension between financial innovation and stability remains a central challenge. The hidden history of financial crises teaches a profound lesson. Economic systems are dynamic and vulnerable. Each crash forces societies to adapt, to innovate, and to strengthen the structures that govern markets. Understanding these events events is not an academic exercise. It equips investors, policymakers, and citizens with insights into the behavior and mechanisms that could trigger the next crisis. History, as it always does, whispers a warning. The next crash is not a question of if, but when. By studying these hidden financial crises, we not only uncover the past, we gain the wisdom to navigate the present, and perhaps the foresight to protect our wealth in an uncertain future. The lessons are clear, the patterns persistent, and the stakes higher than ever. How prepared are we to learn from history before it repeats itself?